MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob, and happy weekend.
Yeah, well, Friday is always welcome, as is the weekend, and we've had some interesting markets. As we've been talking since Christmas time, once that hit to the financial markets had washed out, and it did become very oversold right at Christmas. That was both on stock things and also on crude oil. The two do trade together. And then we were looking for a rebound out to around March, which is a seasonal target. Often copper can rally till March. So a number of things going on. And then what provides validity to the outlook is when you have reliable technical indicators to come along and say, yeah, you're getting some excesses in here. Well, we've had a couple of bursts of them. Around February 21st, there was quite a few upside exhaustion readings and things like that. And then it backed off a bit, and then we've had this other rally, essentially tied to crude oil. And we're starting to get some signals on the crude oil now. So the question we ask like this is the market up when it should be? Yep. Are there signs of speculation? Yes, that would be momentum and pattern. Sentiment number is up to, I think it was 83%. And at the high in January 2018, it was 91% or something like that. But the main thing, this is the highest sentiment figure since then. So we were looking for a rally out till March, and hopefully a strong enough rally to generate some signals, which it has. So, and then going the other way, the U.S. dollar was likely, the DX index was likely to trade in a range between 97 and 93 through the first quarter, and it traded around, but there's been going back to September, a series of higher lows on each of the corrections. And two of those lows had sequential buys, and then the recent low had a springboard buy. So the dollar index has been acting well, and other than the astonishment of the Federal Reserve not being able to depreciate the dollar at will, it's sending a message, and the message is that in the good times the dollar goes down, and in the bad times the dollar goes up. So we'll want to get to this later on when we talk about precious metals.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWBF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Welcome back. We're speaking with Bob Hoye. Bob, how is gold acting right now, and what do you expect to happen with gold?
Yeah, it's been improving with the rally in industrial commodities, which would be the base metals and copper. They improved. Lumber improved for a while. So this is the kind of climate that your basic gold bug would like and would bid gold up. But it's perhaps bumping its head at this, what I think is a 1360 level. And I'm just not bullish on gold in dollar terms. Other currencies, yes, because one of the things that goes on in a post-bubble contraction is that the senior currency, which is the U.S. dollar, becomes firm against other currencies and against commodities. So you don't have the recipe for a big move up in gold prices, because it has to do with liquidity, whereby careful money, and trust me, there's a lot of careful money around, and there'll be even more so under scarier times. The careful money goes to the most liquid items. The return isn't important. It's in and out that counts. And your most liquid items, of course, are U.S. short-dated notes, T-bills, that sort of stuff. So then as the money sloshes there, that'll put a bid in for the U.S. dollar. And at the same time, another liquid item is gold. And, of course, there's nothing with infinite liquidity, but the money will go to the most liquid items, and money going to gold will be a bid for gold. But the only way you can make money in gold itself is to be in other is against other currencies, the Canadian dollar, the euro, whatever, or even lesser currencies. But our view on the gold sector is that the real price of gold goes down in a bubble. It had its sensational high in 2011, which we pointed out with all our technical stuff, and concluded that it wouldn't be as bad a bear market as what followed 1980. But any bear market you're in is bad, and it has been ugly. But the real price, as deflated by the Consumer Price Index, it's been basing since early 2017 as the great bubble was blowing itself out. And this is the way financial history has worked in the past. But last month on the posting on gold divided by the CPI, it broke. It's been turning up for the last few months, but it broke a long downtrend line. And this thing is only meaningful on a month-to-month basis, because that's when the CPI is posted. So the next month or so will be interesting, and my guess is that it is early stages of an uptrend. And the importance to the gold miners is that with a rising real price, it reflects profitability, operating margins, whatever you want to call it. And each of the post-bubble periods in the past, one of the features has been a rising real price of gold, and the gold miners making all kinds of money, and speculators in gold stocks making all kinds of money. So you don't have to have the U.S. dollar going down to have a great bull market for the gold mining stocks. Its history has shown us this. So the entry has been tricky. We had a buy on the 1st of November, and we took a modest position, and at some point we'll add to it, because when the bull market for gold sector is based upon a financial contraction, and those are nasty, and so the gold stocks will get whipsawed around, but with our technical work, we should be able to add to positions on nice timing.
We'll have more with Bob Hoye right after the break.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, what's going on with all of these inverted yield curves?
Yeah, it's a fascinating subject, and it's important. I've got the yield curve in the U.S. back to, I think it's 1857, 1860 anyways, and it is the difference between short-dated instruments and long-dated, like treasuries or Government of Canada's. And in a boom, short rates go up because, as I explain it, there's an increasing demand for by speculators to get leverage, and then that forces up short rates. So the last summer was critical in that our work on the yield curve, with this history going way back, was that you didn't need to have the curve actually invert. In a boom, it flattens, but there are examples in history where the curve approached inversion, and the key thing was when it reversed, and this is what happened last summer. It reversed in August, I think it was, and that to us was the signal. Plus, when the credit spread started to widen, that was early October. So at any rate, the yield curve last summer, if you have enough information on the curve, worked for us and for our subscribers, and because we were looking for the liquidity crisis in the fall, and that it could run to as late as Christmas, which it did. So, but now you've got actual inversion, I think, out to the 5-year, at least when I looked at it the other day. And this is now for many more important. But Jim, the overall importance is that the Federal Reserve has no control over the yield curve as you approach a cyclical peak, and that's why they happen. The other thing is they have no control over credit spreads. That's all in the market. The public determines that. So on the credit spreads, which is the difference between high-grade bonds and low-grade bonds, it worked for us last summer, as I mentioned, and often, like in looking at what we did in 2007 and 2000, in order to change the trend in spreads to adversity, it takes two breakouts. Last summer in June, and then the second breakout was, I think, early October. And then that was the warning, and then everything worked fast after early October because the price of crude went down. So now, then with the crisis down into December, the curve widened. Spreads widened. And then, of course, with coming out in the good times into March, the curve spreads did narrow. So we got the narrowing. But now, on a possible reversal to adversity, we've had the first breakout in spreads widening. We use the CCC corporate spread against treasuries. So we've got the first warning, the first breakout. So what we will do, and we'll advise our subscribers when we get the second breakout, because that one could be the killer. And we don't know at this point, Jim, whether it comes next month or May or who knows when, but one has to be aware of it. And the important thing, I'm really going to stress this again, is that the Fed has no influence on the curve or on spreads, and otherwise it would be a perfect world. You wouldn't get the reverses in the credit markets that then push off bear markets for stocks, and also that's associated with recessions. And I want to mention that one of the reasons, one of the promoters of the forming the Federal Reserve in the early 1900s, one of the reasons is that the Fed, as being a lender of last resort, would prevent the financial setbacks that preceded recessions. That was the theory. There's been 18 recessions since the Fed opened its doors for business in January of 1914. So it doesn't work. And yet there are so many people that rely upon what they think the Fed is going to do. I'm sure that many people within the Federal Reserve System have a pretty good handle on whether it works or not. And then with the curve inverting, the key now is when it starts to go the other way. And you already got first step on spreads widening. We're going to see once again that the financial markets overwhelm the central bankers. And at some point, Jim, the public's going to take a look at this and say, hey, you guys risked trillions of our tax dollars in trying to prevent bad things from happening. So I think we're in the popular uprising on a contraction will then become very critical of the interventionist Federal Reserve System and all the damn fool economic theories that go with it. You know, we could be going into a new bull market for common sense.
Bob, thank you so much for chatting with us.
Well, here we are. We've wrapped up our Friday chat, which I always look forward to, and look forward to getting together next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.